Welcome to the Deep Dive.
Yeah.
We're the show designed to, well, cut through the noise on some pretty complex topics.
Yep, our mission is simple. Give you, our curious learner, a real shortcut. We want you to be truly well-informed.
We do that by distilling the most important stuff, those key insights, and maybe surprising facts from dense sources, really tailoring it for you.
And today, we're diving deep into the future of global fintech. It's a big one.
It is. Our main guide here is the Future of Global Fintech, second edition report.
Yeah,
it's a pretty authoritative study.
Yeah, just published June 2025 by the World Economic Forum and the Cambridge Center for Alternative Finance, CCA.
And this isn't just, a quick look. It's a major global study, the second edition.
Based on solid empirical data, they surveyed 240 fintech firms, carefully chosen ones.
And these firms cover, 6 key areas,
Right.
all retail-facing?
Exactly. You've got digital lending, digital capital raising, digital payments, digital banking and savings, insurtech.
And wealth tech, right. That one's new for this edition.
That's right. Wealth tech's the new addition. And the scope is just massive, geographically speaking.
Yeah, firms from 59 different countries operate in over 100, spanning 6 big regions.
Asia Pacific, Europe, Latin America, and the Caribbean, LAC, Middle East, and North Africa. M&A, the U.S. and Canada, and sub-Saharan Africa. So truly global.
So the goal here for the report and for our deep dive today is really to benchmark things, see how fintech is evolving.
Look at the opportunities they're grabbing, but also, how they're handling challenges, things like the shaky economy, regulatory hurdles.
Always a factor. So we'll be unpacking where fintech stands now, how it's changing, its impact on getting more people into the financial system.
Financial inclusion, yeah. Plus the huge role AI is playing now and what the industry itself thinks is coming down the pike.
Okay, sounds like a plan. Let's unpack this.
All right.
So first up, this idea of fintech transitioning to sustainable growth. We all saw that crazy expansion sped up by the pandemic. What does sustainable actually look like now?
That's a really good question. It basically means the industry's maturing. It's finding a more stable rhythm.
So less chaotic growth?
Yeah, less explosive maybe. Like customer growth between 2022 and 2023 averaged 37%. Now that's down from the 55% surge we saw in 2020-21.
Okay, so a slowdown, but still pretty decent growth.
Exactly. 37% is still really healthy. And crucially, the financial performance is strong. Revenue growth is holding up at 40%, and profit growth is right there too at 39%.
Okay. So it's not just about grabbing new users anymore. It's about building a solid business.
Precisely. It's a shift towards deepening the value for the customers they have and, actually making money from them, not just scaling user numbers at all costs.
That makes sense. A sign of maturity, like you said. Did the report show any particular regions or types of fintech leading this charge?
It did, yeah. Regionally, the U.S. and Canada, MN, and Latin America really stood out. They led in customer growth.
Around 40-something%?
Yeah, 44%, 42%, 42% respectively. And LAC, Latin America, was actually the top for revenue growth at 46%. APAC and MENA were close behind.
Okay. And profit growth followed a similar pattern.
Pretty much. LAC, US, Canada, and MENA led there too, all over 40%. So those regions are clearly hotspots right now.
And what about the different fintech sectors? You mentioned digital banking earlier.
Right. Digital banking and savings was a real powerhouse. Led in customer growth over 40% and absolutely dominated revenue and profit growth 67% and 59%. Huge numbers.
Oh. So that sector's really clicking.
It seems so. Digital payments and wealth tech also saw strong customer growth. But on the other side, insurtech and digital capital raising, they had the slowest growth rates. Suggests maybe tougher markets or they're still figuring things out.
Interesting. So for you listening, this paints a picture of an industry that's, growing up, focusing more on substance over just sheer numbers.
Definitely. Deepening those value propositions.
Okay, so what's actually driving this growth? What are the main engines? And conversely, what are the brakes still being applied?
Well, some key drivers are pretty consistent. Consumer demand is still massive. 90% of firms said it was supportive. That's fundamental.
Yeah, grow with how customers wanting what you offer.
Exactly. And then access to skilled talent. That remains a top 3 enabler in most places. Finding the right people is crucial.
And what about the users themselves, their savviness?
Yeah, digital and financial literacy. That was seen as supportive by, 70% combined, 13% very supportive, 57% supportive. So customers are getting more comfortable with these tools.
That's encouraging. And what's perhaps more encouraging is that some of the big roadblocks seem to be shrinking.
That was a really interesting finding, yeah. Macroeconomic factors, inflation, instability, all that's still a challenge for 18%.
But that's way down, right?
Way down. It was 56% in the previous study. Huge drop. Same story for the funding environment. Only 12% see it as a hindrance now, down from 40%.
And regulation, too.
Regulation, too. Only 11% see it as a hindrance, down from nearly half, 47%.
Wow. So what do you think's going on there? Are things genuinely better, or have fintechs just gotten better at navigating?
Probably a bit of both. The operating environment might be a bit more stable, maybe better understood, but also the industry's adapted. They've weathered those initial shocks.
Makes sense.
Yeah.
Now, building on that idea of navigating partnerships, this jumped out at me. 84% of these fintechs partner with traditional banks or financial institutions.
Yeah, 84%. It's huge. It really underscores how much collaboration is happening now. It's not just disruption, it's integration too.
So what kinds of partnerships are most common?
Mostly API integrations, that's about half. Using each other's tech building blocks, then acting as technology providers for the incumbents, and importantly, funding agreements.
Funding agreements. So incumbents investing in or lending to fintechs.
Exactly. And that was especially critical in sub-Saharan Africa. Over half the fintechs there said access to capital was a key challenge, and these partnerships were a major way they addressed it.
So it's really practical stuff. Solving tech needs, getting credibility, accessing capital.
Uh-huh. Enhancing credibility and trust by partnering with an established name was a big motivator, alongside getting new tech or building new products together.
Right. And sticking with funding. Perceptions improved overall, but still, about a third of firms saw the funding environment worsen in the last year. What makes the difference in getting funded now?
Well, it seems to tie into those broader market corrections we've seen. It's less about hype now. The report strongly suggests it comes down to fundamentals.
Like
Quality of the business model, 66% said that was critical. And just the general availability of VC or private equity funding, that was key for 72%. So you need a solid plan and available capital in the market.
less froth, more substance.
Okay.
What about looking outwards, international expansion?
Still a big ambition for many. Over half, 55%, plan to enter new markets in the next year.
Anywhere particularly keen?
M&A and Europe showed the strongest intentions, both over 60% planning to expand.
But it's not easy, right?
No.
What are the main hurdles going international?
Number one is complex regulations and licensing in new countries. That tripped up 68%.
Always the red tape.
Always. Then adapting products to fit local needs. That's 58%. And building local partnerships, nearly half cited that.
And does getting funding for expansion differ?
Yeah. Access to capital for expansion was a bigger issue in emerging markets. The EMDEs, about 40% cited it, compared to around 32% in advanced economies, the AEs.
Gotcha. Okay, let's pivot to regulation itself. How do fintechs feel about the rules they operate under?
Overall, it's adequate. 62% said the regulatory environment was adequate and appropriate. That's pretty consistent with the last report.
So not terrible, but maybe not amazing either. Where's the room for improvement?
Well, things like reporting and compliance processes, they actually rated those quite positively, nearly 85% adequate or strong.
Okay.
But where regulators could do better is their own knowledge and capacity regarding fintech. Almost a quarter rated that as poor.
Ouch. So regulators maybe don't fully grasp the tech or the business models?
That seems to be the perception for a chunk of the industry. And licensing and registration processes were also seen as poor by 23%. So making it easier and clearer to get started is still needed.
And what is working well on the regulatory support side? What mechanisms are helping?
Things like electronic KYC, know your customer, and simplified due diligence. Half the firms found those effective. That speeds up onboarding.
Makes sense. Less paperwork, faster service.
Exactly. And fast retail payment systems were also seen as effective by almost half. Standardization on cybersecurity and fraud prevention helps too, though maybe less universally effective yet.
What about open banking or open finance? That feels like it should be a huge enabler.
You'd think so. And fintechs agree it's relevant. 93% see it as important for the future, but the reality on the ground is uneven.
How so?
Only 29% actually find the current frameworks effective. Almost as many, 24%, find them ineffective, and another 23% say they're needed but just not available where they operate.
So massive potential, but the execution or availability is lagging way behind.
Seems that way. A real gap there.
So looking at the whole regulatory picture, what's the big takeaway for you? You mentioned the link to growth earlier.
Yeah, that correlation really stands out, especially in emerging markets. Where regulation was seen as adequate, customer growth was 39% higher, and revenue 37% higher.
That's a direct link.
It really underscores how crucial getting the regulatory balance right is. It's not just about safety. It directly fuels growth and, importantly, financial inclusion.
Perfect segue. Let's talk about financial inclusion. The report really flags this as a core part of fintech's value, right?
Absolutely central. They're proving they can reach and serve segments that traditional finance often struggled with or found unprofitable.
So who are we talking about? Which groups?
Well, MSMEs, micro, small, and medium enterprises are a huge segment, 57% of customers. Low-income populations make up 47%, and women, 41%.
And you mentioned some groups saw particularly high growth recently.
Yeah, seniors and people in rural or remote areas, they saw the fastest growth in 2023, 11% and 9% increases. So fintechs are actively expanding their reach.
And crucially, it's not just charity work. Serving these groups is actually good business.
It really is, especially in those EMDEs. Low-income customers, for example. Their contribution to revenue jumped 17 percentage points year over year. They now account for 43% of revenue for fintechs focusing on them in those markets.
Wow, 17 points. That's a massive shift. It shows that serving the underserved could be a core profit driver.
Definitely. And fintechs are consciously building for it. Products specifically targeted at MSMEs increased by 10%, now offered by 58% of firms.
And again, the emerging markets are leading here.
Yeah, EMDEs are way ahead in offering targeted products for these groups. Like 70% offer MSME products compared to just under half in advanced economies. They're really leaning into inclusion.
So how do they actually reach these diverse customer groups? Is it all just ads on social media?
Social media is big, yes, 77%. Websites too, 76%. And referrals are huge, 72%. Those are the main channels overall.
But what about those harder to reach rural or remote customers?
They use more tailored methods there. Things like networks of local agents on the ground, 43% use that. Offering services in multiple local languages, that's 42%. And even running financial literacy programs, 31%, to build trust and understanding.
So a really flexible, adaptable approach depending on the customer.
Exactly, it has to be.
Okay, let's shift gears to something that's everywhere now. Artificial intelligence, AI in fintech. How widespread is it, according to the report?
It's incredibly widespread. 80%, 80 of the surveyed firms have either implemented AI or are actively in the process. And many aren't just dabbling, they're weaving it into multiple parts of their business.
80%. So it's moved well beyond the experimental stage. Where are they using it most?
Top areas right now are customer service, think chatbots, personalization, that's 37% implemented, then process reengineering and automation, 34%, making things more efficient internally, and risk management, 32%, using AI for fraud detection, credit scoring, things like that.
So really core functions. It's becoming fundamental.
It really is.
And what impact is this having? Is it actually improving the businesses?
The data suggests, yes, significantly. On profitability, 74% reported improvements after adopting AI, and over a quarter called those improvements significant.
Okay, that's bottom line impact. What about the customer?
Even better there. 83% reported improvements in customer experience, and almost half, 49%, said those were significant. So customers are feeling the benefit.
And cost savings.
Yep. 75% saw improvements there, 23% significant. So it's hitting efficiency, customer satisfaction, and profit.
The trifecta. Now, this is interesting. What about jobs? The classic AI fear is job losses. What did the report find?
This was actually quite counterintuitive, maybe. Half the firms, 50%, reported no change to their workforce size after implementing AI.
No change.
No change for half. And get this. More firms increased their workforce 38% than reduced it, which was only 12%.
Wow. So AI implementation is correlated with hiring more often than firing.
In this fintech survey, yes. Especially in digital banking and savings, they saw a massive 58% increase in workforce alongside AI adoption.
So maybe it's less about replacement and more about augmentation. Needing new skills to manage the AI or freeing up people for higher value tasks.
That seems plausible, and it aligns with another finding. 71% reported an increase in their R&D spending, likely investing heavily in developing and integrating these AI systems. So it's creating new needs, new roles, perhaps.
Fascinating. But AI isn't all roses, right? What about the risks? Are fintechs worried?
Oh, definitely. Very aware of the risks. The vast majority, between 71% and 84%, depending on the specific risk, rated them as moderate to very high.
What are the absolute top concerns, the things keeping CTOs up at night?
Number one, data breaches and privacy violations. 84% flag that. Right behind it, AI-generated deepfakes, 83%. And cyber attacks enabled by AI, 79%.
So security and manipulation are huge worries.
Huge. But also concerns about AI potentially worsening bias and discrimination, 74% worried about that. Systemic risk creeping into the financial system through AI, 71%. And market concentration, like a few big AI providers dominating, also 71%.
So a whole spectrum of complex risks they're grappling with.
Yeah, it's not simple.
And what's stopping them from implementing AI even faster or more broadly? What are the
It's
barriers?
the biggest one. Cost. Just the sheer expense of implementing and maintaining these sophisticated AI systems, that was a challenge for a whopping 87% of firms.
87%. So it's a major
A
investment.
huge one. Other big hurdles include accessing good quality data to train the AI, 69% cited that. Regulatory uncertainty around AI, 77% worried about unclear rules.
And talent again, even with the workforce increases.
Yeah, access to skilled AI talent. While maybe not the top barrier overall, it was still a slight hurdle for 51%, and a particularly significant one for digital lending firms. Finding people who understand both AI and finance is tough.
Okay, so powerful tech, big benefits, but also significant risks and barriers.
That sums it up pretty well.
All right, finally, let's gaze into the crystal ball. What does the industry see coming down the track between now and 2030? What topics do they think are most relevant?
Unsurprisingly, AI in finance topped the list. 74% called it most relevant. It's clearly front and center.
Okay, after AI, what's next?
Regional interoperability came in second. That desire for smoother operations across borders, making things work seamlessly between countries. 53% rated that most relevant.
That links back to the expansion challenges we talked about.
Exactly. And close behind that was embedded finance, 52%. The idea of weaving financial services directly into other platforms, like booking a trip and getting insurance offered right there.
So AI, smoother borders, and finance disappearing into other apps. That seems like a plausible future.
It does. What's maybe more telling, though, is what they ranked as least relevant for the next 5 years.
Oh, what fell to the bottom?
Things like central bank digital currencies, CBDCs, sustainable and green finance initiatives, and even blockchain technology and DeFi. They consistently ranked lowest.
That's kind of surprising, especially CBDCs and green finance, given the broader discourse. Why do you think they're seen as less immediately relevant by the fintechs?
It probably reflects a very pragmatic focus. They're looking at what directly impacts their business models and growth strategies right now or in the very near term. AI, interoperability, embedded finance, those have clear, tangible applications for them.
Whereas CBDCs are more infrastructure level.
Mm-hmm.
And green finance may be seen as important, but not the core driver yet.
Potentially. It's not that those things aren't important overall, but for this specific group of retail-facing fintechs, the immediate priorities lie elsewhere.
Makes sense. And speaking of infrastructure, what improvements to the underlying digital plumbing, the digital public infrastructure, or DPI, would help fintechs the most?
They had some clear asks there. Top was integrated eKYC and AML platforms, 60% wanted that, making customer verification seamless and compliant across the board.
Again, reducing friction.
Exactly. Also, streamlined digital payment systems, 52%. And comprehensive open data initiatives, making more data securely available, 44%. Basically, building a more robust, integrated digital foundation for everyone to operate on.
Okay, so better ID, better payments, better data sharing.
That's the wish list.
Wow. We've covered a lot of ground.
Yeah.
This report really paints a picture of, well, like you said, a maturing fintech sector.
Yeah, it's not just about explosive growth anymore. It's becoming more resilient, definitely more collaborative with traditional finance, and really embedding itself in that mission of financial inclusion. Plus, the whole AI piece, the adoption, the impacts, the challenges, it just shows how dynamic things are.
It really does. So here's a thought to leave you with.
Yeah.
We've seen fintechs figuring out how to make real money serving people traditional finance, often overlooked.
Right, that profitability in underserved markets was striking.
And at the same time, they're leaning heavily into AI for efficiency, for better customer experience, for new products. So when you combine that focus on inclusion with the power of AI, what does that signal for the future of finance overall? How might that combination reshape how we think about profit, about ethical responsibility, about who gets access to financial tools in this digital age? What new doors or maybe new risks does weaving AI and inclusion together open up for your financial future? Something to mull over.